There's a number floating around finance right now that sounds almost fake. $41 trillion. That's not a typo, and it's not some made-up doomsday figure from a guy yelling into a camera about gold. It's the size of the lending market that a group of companies most Americans have never heard of are quietly trying to take over, one piece at a time. You've probably heard the other number, 1.8 trillion. That's how big this industry already is. And if you've heard of it at all, you've heard it called private credit. And you've probably heard it described as boring, safe, institutional, the kind of thing pension funds do. Here's the problem with that story. Regulators on 3 continents stopped believing it about 6 weeks ago. And by the end of this video, you're going to understand exactly why. And more importantly, why it might already be sitting inside your own retirement account without you knowing it. Let's strip away the jargon for a second, because that's the first trick this industry plays on you, burying a simple idea under a complicated name. For about 100 years, if a mid-sized company needed to borrow money, there was really one place to go. A bank. The bank takes your deposit, the bank lends it out, the bank manages the risk. Simple. Then 2008 happened. Regulators looked at banks and said, essentially, you're holding too much risk on lending that could blow up. Hold more capital against it, or stop making those loans. So banks did the rational thing. They pulled back from the riskier, less standardized corner of business lending. That gap didn't stay empty for long. Asset managers, the same kind of firms that run hedge funds and private equity, stepped into it. Instead of a bank using your checking account deposits to fund a loan, these firms raise money directly from investors, pension funds, insurance companies, and increasingly, regular people, and lend it straight to companies. No bank in the middle. Think of it less like a bank and more like a private lending club that doesn't have to follow any of the rules banks follow, doesn't have to disclose what it's holding the way a public company does, and doesn't trade on an exchange where you can see the price update in real time. That's private credit. And for over a decade, it worked beautifully until the cracks started showing up exactly where nobody was looking. Okay, back to that $41 trillion number, because I promised you an explanation and you deserve one before we go any further. Private credit itself, the actual amount currently lent out, is somewhere between $1.5 and $2 trillion, depending on which regulator's estimate you trust. The Financial Stability Board, which is basically the group of central bankers and finance ministers from the G20 who watch for the next financial crisis before it happens, published their official number in May, somewhere in that $1.5 to $2 trillion range, concentrated heavily in the US, then the Eurozone, then the UK. So, where does $41 trillion come in? That's the total addressable corporate lending market private credit firms are aiming at. The entire pool of business lending currently sitting with traditional banks that these firms believe they can eventually capture. Industry estimates suggest private credit could realistically take over up to 15% of that pool as banks keep tightening their lending standards and public credit markets keep merging with private ones. So, this isn't a $1.8 trillion story. It's a $1.8 trillion industry standing at the edge of a $41 trillion buffet. And it's already eating faster than anyone expected. And here's the part that should actually get your attention. It's not just companies borrowing this money anymore. Over the last 2 years, this industry has started marketing directly to retail investors, people like you and me, wrapping these loans into products that show up in brokerage accounts and retirement plans. So far, this probably still sounds like a new opportunity story. Bigger market, more access, more competition for banks. Sounds healthy, right? Here's where it stops sounding healthy. Proskauer runs something called the Private Credit Default Index. It tracks nearly 700 loans worth about $189 billion. In the first quarter of this year, the default rate on those loans hit 2.73%. 2 quarters earlier, it was 1.84%. That's not a small move. That's the default rate nearly doubling in roughly 6 months. And that's the optimistic number. Fitch Ratings reported in May that the U.S. private credit default rate hit a record 6% in April. Bank of America's own credit strategy team has gone on record calling private credit the lowest quality asset class in their entire leverage finance universe. And that's coming from people who work in finance for a living, not from someone trying to get views on YouTube. Now, Different ratings agencies measure this differently, and the range is genuinely wide. Moody's puts current defaults somewhere between 1.6% and 4.7%. S&P's speculative grade benchmark sits around 3.7%. And on the bearish end, UBS has modeled a severe downside scenario of 14 to 15% if things really deteriorate. Morgan Stanley's number for a weaker economy is closer to 8%. That range matters less than what's hiding inside it. A huge share of the defaults that already happened in 2025, Moody's estimates roughly 65%, weren't clean defaults. They were distressed restructurings. Companies extending their loan maturities or swapping debt instead of admitting they couldn't pay. And there's a specific red flag tied to this called PIK income, payment in kind, where instead of paying interest in cash, a borrower pays it by taking on even more debt. It's the financial equivalent of paying your credit card bill with a different credit card. Rising PIK income across this industry is one of the indicators analysts are watching most closely right now, because it usually means the cash to pay real interest just isn't there anymore. Here's why a default rate ticking up in a corner of the lending market most people have never interacted with should matter to you. It's not contained. It's wired directly into the institutions you already trust with your money. Start with the banks. The Financial Stability Board's official count shows around $220 billion in drawn and undrawn credit lines from banks to private credit funds. But that's the conservative number. Commercial estimates put the real figure at 2 to 4 times higher. And Moody's separately estimated bank exposure was approaching $300 billion. Banks like Barclays, Deutsche Bank, and BNP Paribas have all now publicly disclosed private credit exposure in the tens of billions each. Now add insurance. This is the part almost nobody talks about. Life insurance companies have become, in the words of the Financial Times, the lifeblood of private credit. Researchers at the Chicago Fed estimated life insurers' private credit holdings reached $849 billion in 2024, more than double what it was just 10 years earlier, and close to half of the entire industry. Why does that matter? Because that money isn't just sitting in a hedge fund spreadsheet. It's backing the annuities that real retirees depend on for income every single month. One asset management executive described the worst-case version of this as a doom loop. If retirees get spooked and start surrendering their annuities for cash, insurers are forced to sell illiquid private credit holdings at exactly the wrong time, which deepens the stress, which spooks more retirees. It's a chain reaction that starts in a corner of the market you've never seen and ends at your grandmother's monthly check. To be fair, the industry's response to this isn't unreasonable. Insurers say they're holding the safest private credit assets, not the software company loans currently under the most pressure. That distinction matters, and it's worth not panicking over a single scary paragraph. But trust us, it's the safe stuff is also exactly the kind of reassurance that tends to get repeated, right up until it isn't true anymore. This is the part of the story that moved fastest, and it's happening right now, not in some hypothetical future. The Federal Reserve has started directly asking major U.S. banks for detailed breakdowns of their private credit exposure, how much debt these funds have taken on from the bank, what it's backed by, what happens if it sours. At the same time, the Treasury Department has separately opened a line of questioning with the insurance industry about the exact same thing. And it's not just a U.S. story. The Financial Stability Board's chair, Andrew Bailey, said publicly that private credit may be facing additional stress following the market shock tied to the recent Iran situation. A reminder that this industry doesn't exist in a sealed room. It's exposed to the same geopolitical shocks as everything else, except with far less transparency about how exposed it actually is. The Bank of England is now running stress tests on the sector directly, and their deputy governor has flagged concerns specifically around asset quality, valuation discipline, and liquidity, which, translated out of central banker language, basically means we're not sure these things are worth what they say they're worth, and we're not sure you could sell them quickly if you needed to. When the people whose entire job is preventing the next financial crisis start asking the same question at the same time from 3 different angles, that's usually not noise. That's a pattern. Let's make this concrete instead of abstract, because vague warnings about an industry are easy to ignore. Specific numbers from specific funds are harder to. Blackstone's private credit fund, one of the largest retail accessible vehicles of its kind, reported a debt-to-equity ratio of 0.7 times at the end of last year. Blue Owl Credit Income Corp sat at 0.8 times in February. KKR's FS Income Trust was right around 0.7 times as well. On their own, those numbers don't scream danger. Leverage is a normal part of how these vehicles generate returns. But layer that leverage on top of a default rate that's tripled in some measures over the past 2 years, and you start to understand why the Fed isn't just casually curious about exposure anymore. Leverage doesn't create risk. It multiplies whatever risk is already there. And right now, multiplying is exactly what the default numbers are doing. There's also a quieter mechanic worth knowing about, called a synthetic risk transfer, where a bank essentially pays a private fund to take the risk of a loan off its books, while the bank still technically holds the loan. The Basel Committee, which sets the global rulebook for bank capital, flagged this directly. If these risk transfers keep growing unchecked, and the private funds taking on that risk can't actually absorb it when something goes wrong, the whole point of transferring the risk in the first place falls apart. Here's the part I want you to actually sit with, because it's easy to watch a video like this and file it under things rich people deal with. This industry spent its first 15 years almost exclusively serving institutions, pension funds, endowments, insurers. That's changed fast. Private credit products are now actively being packaged and marketed toward individual investors, sometimes through retirement-adjacent products, sometimes through funds that advertise steady, bond-like income with a higher yield than you'd get from a regular bond fund. That higher yield isn't a coincidence, and it isn't a gift. It's compensation for risk and for liquidity you're giving up. The same way a higher interest rate on a sketchy loan compensates the lender for the chance it doesn't get paid back. The product doesn't trade on an exchange. You may not be able to sell it quickly if you need the cash. And the value you're shown on a statement is often based on the fund's own internal estimate, not a real-time market price, which is exactly the opaque valuation problem regulators keep flagging. None of this means private credit is a scam, or that everyone holding it is in danger. Plenty of these loans will be repaid exactly as planned. But higher yield, lower visibility, harder to exit, is a combination that deserves your attention before you're in it, not after. I'm not a financial advisor, and this isn't a recommendation to buy or sell anything. But here's how I'd personally think about it. Firstly, if you own any fund, annuity, or retirement product, and you genuinely don't know whether it has private credit exposure, that's worth a 5-minute phone call to find out. Not because the answer will necessarily be bad news, but because I don't know is the exact position you don't want to be in if this sector tightens further. Secondly, pay attention to liquidity terms before yield. A fund offering monthly or quarterly redemptions sounds flexible, but in a real stress event, those redemption gates are usually the first thing that gets suspended. If you can't answer, how fast could I actually get this money out in a bad year, you don't fully understand what you own yet. Thirdly, watch the regulators, not the headlines. Individual scary news stories about private credit will come and go. What actually matters is whether the Fed's bank exposure questions, the Treasury's insurer inquiries, and the Bank of England's stress tests turn into new disclosure rules. That's the signal that tells you whether this stays a slow, manageable unwind or turns into something faster. Every financial crisis in the last 100 years has had the same basic shape. Money moves into the part of the system with the least light shined on it, because that's where the returns look best, right up until it's where the losses show up first. Private credit isn't a scandal, it's not 2008, but it is, by the admission of the people whose entire job is watching for the next one, the least transparent corner of the financial system currently growing the fastest. That combination is worth understanding, not fearing. If you want me to keep digging into where this goes next, the insurance side specifically deserves its own video. Let me know in the comments, and I'll go build it. I'll see you in the next one.